Cost volume profit analysis, or CVP analysis for short, is an analytical tool that uses the relationships among components of the profit equation, price, volume, cost structure, and profit, to assess the financial impact of alternative management decisions. It's very useful because it offers a framework for thinking about the impact of each of these factors, which managers can influence, on profit. And profit is something that managers think a lot about. CVP analysis helps managers answer questions like, how many units does the company need to sell to generate a profit of $10,000? How much does a company need to reduce costs to achieve a profit of $20,000? How many units of a new product does the company need to sell to cover its costs? And what is the impact on profit of a decrease in variable cost per unit of 10%? The use of CVP analysis requires several assumptions, and those include all costs can either be represented as fixed or variable. The price per unit, the variable cost per unit, and the total fixed cost are constant within some relevant range of volumes. The cost function is linear within that relevant range. There's only one cost driver, or only one thing that causes cost to be incurred, and that's sales volume, or the number of units. Production for a manufacturer or purchases for a merchandiser is equal to sales, so there's no beginning or ending inventory to worry about. And if the company sells more than one product or service, the sales mix, or the relative proportion of units represented by each product, remains constant. These assumptions help to simplify what can be very complex problems, and as a result, CVP analysis can be a good place to start in the profit planning process. However, these simplifying assumptions do suggest that additional analysis be conducted before finalizing your profit plans.